So, hi Taranjit, welcome to Money Matrix, and thank you so much for joining me today. I'm really glad we could make this happen. This is actually my first podcast, so I wanted to start by having a simple and honest conversation with someone who works in a really interesting part of finance. I've heard that you've worked across quant trading, options, and volatility, and you've seen how markets work at a very deep level. So today, I just wanted to break things down in a simple way, as in what quant trading really is, how options and the VIX work, and what your journey into all of this looked like. So, to start off, for someone hearing about this for the first time, can you explain what you do in simple terms?
Oh, but first of all, thank you for having me here. It's a pleasure to be talking to you. And then, because when I was a kid, I didn't know anything about trading, so it's a pleasure and honor that I'm able to share the things I've learned so far with young and bright people like yourself and so on. So yeah, so what I do for work, it's like in simple terms, I'm a market maker in the option space. And how do you explain a maker? So imagine you go to a foreign country, and then you want to exchange your own currency with a foreign currency. You see all these desks that do your currency exchange, but then when you look on their chart sheet, you see they have two prices. If you want to go from say USD to pounds, they charge a different rate. But then if you want to go from pound to USD, that'll be a different rate for the same currency. Why do they do that? The difference in those rates is their spread. So they are banking that one person will conversion A, the other person will do conversion B, and then they won't have any exposure, and they will collect that spread. So that's pretty much I do in terms of trading, in the sense I'm a market maker for options, where I'm always sitting there on an exchange, and people who want to trade, I facilitate them by giving them a price they can trade at, so they can get in and out of positions.
Perfect, thank you. So, and what exactly is quant trading? And like, I wanted to know how it is different from normal trading, from like a normal
So
trader.
uh, quant is just a short term for quantitative. So everything we do, any position we put on, it's driven by some kind of quantitative analysis, some kind of system. So it's not just, it's like, oh, I had a gut feeling that this is going to go up, I should buy that. So it's more that, okay, I have this algorithm that's looking at all this data, trying to find patterns, and they recognize the pattern, and then based on this pattern, we should either buy this or sell this. So normal trading these days, pretty much everyone is using some kind of quant farm, but then people have quantamental, where they look at fundamental data, but in a quantitative way, and then they invest in long-term stuff. And quant trading can be from high frequency trading, mid frequency, where like you're holding stuff for a few minutes, a few hours, few weeks. So it doesn't have to be that you're just like getting in a position super fast. It could be like you can do it on a longer term horizon or a shorter term horizon.
Okay, got you. So, like, I just wanted to know because that's the field I want to go into. So, how did you first get interested in markets and trading, and like, what was the spark?
So the spark was it's like some of my friends who were into this. I didn't have any exposure into trading before undergrad, but then some of my friends did have, so they introduced me. But then the real spark came. It was when I was sitting in a class, and the professor was telling about a research study that a sub professor did in the 90s. So in the research study, the the professor was comparing the prediction of a weatherman in Florida in the 90s, and seeing how accurate those weather predictions by the Weather Channel or the weatherman was, the meteorologist, the local meteorologist. And then the other data that the professor was looking at was the futures market of orange futures. Orange juice has futures that you can trade. So the price of those orange juice futures depends on how warm Florida will be over the next few months. So to be able to price the price of an orange juice future, you need to understand what the weather will be. So then all these trading firms, to hedge funds, will deploy their resources to make those weather predictions and then come up with the price of orange futures. So it's like so you can back out how if the weather is going to be hot or cold based on where this future is trading, this orange juice future is trading. And then comparing what the predictions were made by the weatherman versus the orange juice futures were much more efficient in predicting the weather, and weatherman wasn't as good as it. So it was like, oh, this is very fascinating, right? It's like you can derive the weather from orange juice futures, and compared to someone whose job is to predict weather, they was doing a worse job than some people whose job was just to trade orange juice futures. So that was like my spark that got me into this kind of world.
Oh, that's so nice. That's like really cool. So you've
Yeah.
worked at firms like DRW, Goldman Sachs, and AQR. What did those experiences teach you? Like, what, as in, did you have a different perspective about trading before you went there, and then your perspective changed, or how was the whole experience?
So the whole like looking at a holistic view, it I've worked in different aspects of these firms and working in different problems. The one thing that I got out of it was that uh, the world of trading, the world of investing is huge, and there are many players, but then each player is doing their own thing in a niche way, in a different sector, and so the opportunity for people is tremendous. You like you shouldn't be boggled down by like, oh, it's like I'm going a base XYZ, but then each person is doing this something niche. So it's like there's opportunity for everyone to get in there, make a difference in terms of understanding, learning, optimizing the processes, optimizing the structures, things like that. But also it's like another aspect of this learning journey was I studied computer science and electrical engineering. So then my initial roles were more focused on that kind of uh, invest that kind of scenarios where I was working more on the infrastructure side. So then that slowly gave me exposure into how those people think about investing, and then I slowly made the transition into trading from there.
Okay, that's just a different level now. Okay, and I just wanted to know, because like, what does it mean to like, and how do you build a trading desk from scratch? Like, I just wanted idea about that.
So I'm still learning this along the way. I'm building this. It's everything that I've seen, heard so far. Like all these little things are coming into play right now. It's like when I started, like okay, it's like you have this data. Where are you going to store this data? It's like you actually need a physical server somewhere. What kind of server do you would want? How would you want to communicate from server A to server B? So it's like that's like first the infrastructure side of building a trading desk, and then it's like, okay, now you want to hire a quant researcher. How do you incentivize someone to join a startup versus going to a place like Citadel and a place like IMC or Noctover? So it's like, so then you have to poach this talent, and you don't have infinite resources. You don't have infinite money to be able to pay for quality. So how do you find the best quality while also not being able in a state to pay them top dollar? And then so it's like how do you trust them to take ownership of certain tasks? Do you look for really like talent who are motivated to do work, versus do you look for experience? Experience will come with some rigidity. They have done certain things certain way, and then they won't want to do that. And then it's like, okay, you should have a lot of self confidence, because like now I'm building this trading desk. I'm going against trading desks that have infinite, like not infinite, but so much money that compared to my desk, they have infinite money. So it's like, what I'm trying to do, can they just replicate that if they find out like what we're trying to do? So it's like, so all these aspects you need to be careful of. And then, as I said, like each firm has their niche. So right now, is what will be our niche be? Where will I find that niche where then we can specialize in and no one will come disturb us in the short-term future.
Okay. Okay. So moving on from that, I just like, what are options and like, why do traders use options, futures and options, and what's that whole idea?
So traders, more of a sense, investors use them. So it's like traders don't are more of a, it's like any kind of contract that you see thrown around, it exists because some investor wanted to invest into that. So it's like traders are just taking the other side of those investors, trying to find a fair value. So when they have too many investors trying to put in, then traders will come in and they're trying to merge that gap of where we will sell this to investors so that we can make sure that this is the fair value of this contract. And future and options are just are derived, so it's like they're from some kind of stock. So it's like say you haven't, like this doesn't I was talking about earlier about orange juice. So imagine you are a farmer, you want to go sell your orange juice to some company, like say it's like who sells commercial orange juice packed. They can say, okay, today the price of orange juice is $20 per liter. I'm just making that up. But now, for the next season, when as a farmer, I will produce this orange juice in 6 months, I want to make sure the price of this orange juice, I can get some kind of exposure right now. So then what I can do is, okay, agree with someone that at future time, we will trade, I will sell you orange juice at a price, like say $30. So then now I know that I'll be able to sell for $30, but then it's still 6 months from now. So that's why it's called a future, because you're trading on a price that will be in the future, but then you're setting the price right now.
Okay,
So it's like
even if the price goes to 25 or 35, you still have
yes.
30
So
bucks.
you already set that price.
Okay.
So then there's minute differences between forward and then futures, but for like simplicity, that's pretty much basically it. And then options are pretty much like a similar thing, but then there you are giving other person a right to buy or sell at a fixed price where they can choose not to buy it from you. So it's like, imagine imagine I am like a cereal honey bunch cereal company that I sell cornflakes, and in 6 months I have to sell. It's like my lead time to building this factory and selling this cornflakes is 6 months. So I want to fix a price right now that I don't want to be able to buy this cornflakes, like say wheat or rice, more than $30. So okay, so I go into the market. I say I'm going to buy this like a kg of. This is exaggeration, but like a kg of wheat for $3. So I'm settling on that, and then when 6 months come, the price of this wheat is say only $2, and that at that time I can be like, I don't want to buy it anymore. So it's my right that I can buy it or not buy it. Imagine a case where the price was $5, then I would buy it. But then if the price is $2, then I would rather not buy it from you at $3 and buy it at a fair market value from someone else. So that's why it's a contract that will happen in the future, but then you're setting a price where, as a buyer, I can choose I have an option to buy it or not. That's why it's called an option. But then what's the incentive for the person to give it to me? So at the time of giving them a contract, they will charge me a price. They're like, okay, I'll give you this option to you, but then I'm going to charge you, say, 50 cents at the time. So that 50 cents when I gave them, it's the money's gone. I won't get that back. But then
Okay.
after when 6 months come, I can exercise my option to either buy it or not. That's on me, depending on what's the prevailing price at that time.
Okay. Cool. 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 And
Does that make
so,
is that making sense?
yeah, yeah, that makes sense. That makes sense. And then, how is all of this related to the VIX, the volatility index? And like, why is it often called the fear index?
So VIX is just a number that comes from that tells you in the next 30-day period how volatile S&P 500 is going to be. So any kind of stock has some kind of variance, standard deviation, right? It's like so you can have a historical variance. Okay, in the last 30 days, it's like S&P 500 had a variance of daily variance of say 0.5%, 1%, or you can analyze it moves up or down by X%. Is that clear? Do you understand what like this volatility is?
Yeah, so it's basically
It's
just,
like what's the standard deviation and variance in historical terms?
yeah, yeah. So it's basically just like the range it moves in. It's
Yes.
kind of,
In
yeah,
simple terms, yeah, the range it moves in. So now market is always forward looking in the sense everyone wants to predict the future. So then you have this VIX index that's saying the as a general consensus what overall world thinks that in the next 30 days the volatility is going to be X. So it's a prediction. It's a understanding of the market, a consensus of the crowd that over the next 30 days, this is what's the range that S&P is gonna go trade in. What's the standard deviation and variance of S&P 500? And how do you get that? You get that from options, from option prices on S&P 500. So there's a S&P 500 index, and then there are options on that index. And then we already talked about that. It's like what's the option is. So to be able to price an option, you need to first plug into what's your estimated volatility over the next period of time. So then you back out the volatility over the next 30-day period, and that's the index. But then, so mostly, if you have ever seen a stock chart, so when the price goes up, it goes up slowly. But then when there's a drop, there's a sudden drop, right?
yeah.
So most of the volatility comes when the prices are moving down. So that's why it's called a fear index when people are scared that the market is going to go down. So the volatility spikes up when the market goes down. So that means there's like some bad news is going to happen because like usually over time market goes up, but then it goes up in the slow terms. But then when it drops suddenly. So it's like when then overall people are scared that something bad is going to happen, the volatility goes. The people's prediction of the next 30-day volatility goes up. So that's why that VIX captures that, and that's why it's called the fear index.
Okay, got it. And why do the traders care so much about the volatility instead of just prices? I mean, do you guys trade the VIX?
So you can trade the VIX, but any kind of trading firm or hedge fund, they have certain kind of limitations on how much loss they can take before they get fired or they'll get bankrupt, right? So whenever you want to buy or sell something, you want to understand how much that thing is going to change over the next X year, X months, or a year or so. So how do you compute that? You need to understand what's the volatility of this product will do. Imagine if I buy S&P 500 and then I would want to see how much it can go down or up over the next year, I would look at, okay, this is the implied volatility of this. So based on that, I can make projections. Okay, this is how much money I need. This is how much money I can lose. So that's why for any hedge fund trading place, it's the volatility is crucial in the sense they can gauge how much risk they are taking, how much expected return they can make. If they have a prediction model that can tell that in historically you've made X amount of return, okay, it's like you made X amount of return, but then what was the volatility of like how much money did you lose at some point? So you always are comparing your expected return to how much volatile that thing is. So it's like you can make 1%, but then if the volatility was 10%, that means that was just noise. It's like you just like got lucky at that point. But then if you made 10%, but the volatility was only 1%, okay, now you made something. Your returns are really really good, where investor can sleep soundly, caring that okay, if I lose, like the losses will be minimal, but then on the gains will be tremendously compared to how volatile the portfolio will be.
Okay, okay, okay. Got you. And just what skills like matter the most for someone who wants to be a quant trader? Like what what do they have to be really strong in?
It's like you need to be really good at problem solving. So it's like usually most of the people who succeed in quant trading come from either physics background or engineering background or mathematicians. It's like so one of the best hedge funds in the world are in the Renaissance studies. They don't hire anyone who has any kind of finance background. They hire PhDs who are in string theory and physics and in maths. So it's like so the like your brain needs to be able to recognize patterns. You need to understand how model all these things in a way that you can feed into a computer and the computer can make predictions out of it. So it's like you need to be really good at problem solving. You need to be good in maths, probability, statistics, all these kind of things. It's like anyone who wants to go into that and is trying to look up early, you should be focusing on these kind of things.
Okay. And I've heard that you're really good at poker. So how has poker helped you like think differently about risk and decision making?
But poker, so anything in the stock market doesn't guarantee you anything. It's only that you have, it's like if you had to play a game 100 times, you will only win, say, 55% of the time. So, so that means you will be losing 45% of the time, and then you have to take a risk appropriately. Same thing with poker. A good poker player won't win 100% of the time, but then they will win more than 50% of the time. And how do you hold yourself when you are on losing streak, knowing that eventually you will win? How do you control your emotions? How do you not give up your edge while like not giving up information that you have? So so that comes in very crucial in trading as well. In trading, when the market is so efficient that if I have some piece of knowledge and I go trade against another player, and then they will like, oh, why did this fight trade against me? Then they will try to decipher it, and they will like move their prices really quickly. So same thing in poker. It's like you learn that risk reward base case, and then you learn how to control your emotions, how you want to how do you want to bet on certain outcomes, things like that. So that's why there are many trading firms who have poker as part of their training courses as well.
Okay, yeah. I just changed my view about poker and okay. And what do you think is the one common mistake that beginners really make when they're learning about trading, and what's the misconception people really have?
I think when so in all like so far in all my trading interviews, like it's like now it's a little different, but when I was in college, like no one cared about how much I know about finance. Everyone cared about how if I can do probability statistic problems. So it's like you like you should build your foundation on technical stuff and not worry about not knowing anything about finance. You don't need to know what options are until, but then more than that, you need to be good in your math classes. You need to be good in your CS classes if you're a CS student. So it's like, so all are those skills are a lot more important, and companies recognize that, and they will only target test you on the things you claim you're good at. They won't test you on things you're not good at. So I think that's why it's like early on focus on these things and forget about learning about any finance material, because once you're good at that, learning about finance is very easy. I learned everything about options on the job. I didn't know anything about options until I got to my first job.
Okay. So, uh, looking ahead, how do you see quant trading changing in the future? As in, how will AI will it take over humans in the quant game?
So to in certain aspect in quant trading, computers have been already making most of the decisions. Like they're already algorithms trading. So it's, like, machine learning has been in hedge fund space for a very long time. But now, like when people talk about AI, they're talking about natural like language learning models where you can type them in English and then come up with certain things. So I think over time, from a hedge fund trading kind of companies kind of space, it's pretty much gonna go the same, but it's like now they can come and test models much faster. They can go from ideation to testing much faster, so that'll be a change. But then, and then also now retail people, I assume, can if they can get access to data, they can also test out certain things before they actually try to invest their money. So and mm, now I think access to quant trading will become faster and easier, but people who already are doing quant trading, I think for them it's the change is going to be marginal.
So they might have their jobs in danger or something in that level.
No, I think they won't. I think they have already like in this place where they have been doing this for at a certain level. I think they will have to adopt that. It's like now they have to produce these signals this out on at a faster rate, because I think other people who are not so good at before can catch up to them in a faster level. But I don't think they are that worried about this.
Okay, so you don't think that AI can actually take over the quant traders who are actually at a good level and have a lot
No,
of
I don't
experience?
think so. I think because they gives them an advantage to test more things at a faster level as well. So it's like I think they will be okay.
Okay, perfect. So thank you so much, Taranjit. This was like honestly, it's really interesting for me, especially because this is the field I want to go into. So, and again, thank you so much for taking the time to explain all of this to me clearly and the audience. And I think a lot of people hear words like quant trading, options, or VIX, and like really feel intimidated by them. But the way you actually broke it down for us really makes it much easier to understand. And I definitely did learn a lot from this conversation. And again, thank you so much for joining me, and I really appreciate you being part of my first podcast.
Of course, thank you so much. I'm touched that I was your first podcast, and hopefully this can be useful for someone.
Yeah, this is really useful for me, and I think it's probably going to be useful for other people as well. So,
Awesome.
and thank you so much, and
Oops.
yeah, see you.
Bye.